Wild week on the street. Most people were looking for a stock market crash. That's not exactly what happened. Credit Suisse bought for pennies. Debt erased about $17 billion. And then we have the Fed hike and the Yellen misspeak, which just drops the market precipitously on banking concerns. You have Yellen coming out and saying regulators are saying the bank system is sound and resilient. At the same time, small U.S. banks see record drop in deposits. We will discuss why this chart is putting fear into banks, the unparalleled move from rate hikes to rate cuts in 2 weeks. Market volatility has been at highs. 2-year Treasury versus Fed funds. We're going to dive into this deep. It's doing something it's only done 6 times in 40 years. Why insurance is absolutely wreaking havoc. Deutsche Bank, what the commercial real estate market has to do with this move, and how this usually ends. Hello, everybody. We have a ton to go over. News, charts, updates. Let's just jump right into it. So the S&P on the week really didn't go anywhere considering everything going on. Now let's go through the basics here and just deal with some technicals. Here's your DTL, your downward trend line. You are unable to break that. You have what we would refer to right here as an evening star for those that watch those candlestick patterns, which I do. And you can see how that we're acting in here. Now, my larger problem today with this move was here's that trend line, and you can see the doji, and then you can see the break of the trend. So really, all we did today was get to the top of that trend line in a very orderly fashion, and I'll show you what I mean by that in a moment. So you're kind of wedged in here. You're trying to flip back over and maybe push here, despite all the news that came out. So is that possible? Well, anything's possible. Technically, again, we are above the 200-day moving average. We have yet to break it this week. Right? We count the days, it hasn't happened. So we're there, and this is exactly what you're looking to see, and we're hanging in there. So overall, this could have been a lot worse, and it wasn't. Now, if you zoom out on the weekly, the larger issue that I have is whenever you have a long red bar down, as you do right here, you're unable to get over that bar, and that becomes a problem for me. I'd like to be over these red bars because this is just straight selling. And obviously this was the beginning of March when we first started seeing cracks in the regional bank. Now we're starting to see cracks in larger banks, and that could be more damaging. And we're going to get into that and how it's affecting the bond market. Now, if you just look at the area that you're dealing with right up in here, and you can see that every time you try to get over this higher high, you were unable to have that follow through bar. And we're going to have to pay attention to that in a moment because I really want to get into the technicals and the relationship between the S&P and the Nasdaq and what's changed over the past 48 hours. So you can see the rally up. You can see the failure right there. Tries again, get the little gap up over this little hurdle. It looks like you're going to go and push, and it pulls the flim flam and reverses on you, giving you this very bearish pattern, trying to get back up, but not really getting anywhere. So essentially, you are in a trading range. Now, if you just very simply take the low of December and come across, you'll realize that you have yet to be able to close above these levels. And I think that's pretty important. Break below these levels. You're just not able to do that. So you're somewhat wedged in here if you go back from November on. Now, just for point of reference, when you go through a recession, if we're going to go through a recession, and we're definitely going to go through something, I'm comfortable enough saying that right now, and I'll show you some data in a couple minutes here as to why I'm more comfortable saying that now than I've ever been. But if we take a look at this range, and then we just take these outliers out for a moment and say, okay, these are outliers. These are just a couple weeks. They're just blips. Right? They try to get out, and then you never make that higher high. And because you never really make that higher high, you don't really have a break of pattern, which is really kind of how I look at the world. Same thing here. You could say, okay, well, yeah, you had it, but you really just retested that 200 and you've reverted back in there. So if you go back all the way to about May and you look straight across, you can just realize there's very short periods of time that you are out of this range. We would refer to that as a base. So I would suggest that the S&P has been basing. Now, there are reasons why you can base and go higher, and there are reasons why you can base and go lower. Now, if we put in volume by price just to get a snapshot of where all the players are, and you see your line right in here, you can see volume by price. The right here is 39.6157. And that is from 2022 all the way to date. So this is where the majority of action is. Now, at the same exact time, you can come over here and take a look and say, okay, well, that's fairly interesting, because up here, every time we get to that 4120, we start running into an issue. So now we know we're at point of control. We know where the players are. We know where the resistance is on the S&P. Is there something else that we could utilize? Now, if we just take a snapshot here, and what you'll note is that I put in an anchored VWAP right here starting in January. So we can just watch this play out. So we can watch this play out and see how we act around that anchored VWAP dealing with the beginning of 2022. And you can start seeing how we're going to fill in our gap. And of course, this is a weekly chart, and it's just interesting to watch it play out real time. You can see how we battled right there, how we undercut and popped through that range. So you can see the defining movements of this range every time we got to the 2022 level. We started running into an issue, rejection again. So what we're seeing is clear rejection of this level. So for confirmation, what I want to have happen is I want something to happen that has never happened previously. That's what I usually look for. Now, what I would be looking for here is for a higher high close. We didn't really get it here. We got this wonky doji. You never got a higher high close over here ever since the beginning of 2022. You did not get your higher high push here, and you certainly did not get it here. And what you're doing is you're riding this line. So what I would suggest is using this line when you look at the S&P 500 as a demarcation line. Doesn't mean it's a be-all, end-all. Doesn't mean that it can't go up 100 points like it's done previously. But this is a line that if you're looking long-term that you need to be paying attention to. It's still sloping down, and it's still acting as resistance. Now, I really don't care about underperformance of the S&P if it wants to go sideways, as long as we had the Nasdaq and the mega caps. So if we take a look and just go to January 2022, around the same period of time, we'll do that third, and we just drop in that anchored VWAP, you're going to notice something very similar. Tried to get up here. You did get a little further, higher high, but that doji pretty much told you how that was being received. Tried again right here and then rejected, and now you closed right on it. Now, is it possible to push through this? Absolutely. Is it something we should be paying attention to? 100% we should be paying attention to this. And I do think that there is some things here that are way more glaring. So in other words, here is your point of control. And I only want to go back to a little bit of time here. Let me go back to 22 on that. So if you go back to this point of control right in here. Point of control is where you have the most volume and the most trades at one specific price. It doesn't mean that that's the average of all the trades. That would be VWAP. So now you're looking at where point of control is, and that's just where everybody is. So that's where you're going to see the most support or resistance, right? So what you want to do is just watch how that's going to play out, and you can see we're kind of over it, but not really. We haven't gotten that huge push. So if we can get over and get into there, that'd be great. But in front of us is the Nasdaq relative to the SPY. In other words, which one is performing, which one's outperforming or underperforming. Now, during times of growth, you will see that the Nasdaq will outperform. During times of drawdowns, the Nasdaq always comes in more. Now, if you take a look at this over time, and you can just go back, we're only going to go back about 10, 12 years. Let's just go back 10 years. And you just see the constant moving. Sometimes you went sideways for a little bit and you have little bits of periods where you have underperformance. This is pretty significant underperformance for a very long period of time. And that shouldn't really go unnoticed. Now, if we take this little section right here and we just look at this one section from the pre-pandemic, right? Pre-pandemic, through the pandemic, the outperformance, and we just draw right at the neckline. And you will see, let me get right in there, how we're sitting right on that level. Let me get that, perfect. So we're sitting right on that neckline, okay? So if you call this a double top and then you break the neckline of the double top, you can see it tried to come down. You can see how that became resistance. And we're sitting right there trying to flip this again. So the Nasdaq right now, what we're looking for is to continue this outperformance, but we're starting to see signs that maybe that's not the case. So for example, if you just drill into something as simplistic as this and you look at today's action, I need a higher high close to have any level of confirmation. I don't get the higher high close. I get the open being the high and the low was the close. Well, that is pretty toppy situation to happen on a resistance line. That's not what you want to see on any kind of resistance line. Maybe it tests here and then goes again, but I don't know. So we're going to have to watch this carefully. Now, if you look at the beginning of the year to date, you can see the orange is the Nasdaq, the blue is the S&P, and we can see the outperformance. The Nasdaq is just up substantially in regards to where we are dealing with the S&P, and you can just see that difference. But something started happening over the past 2 days. Right as we got to that neckline I just showed you, you can see the Nasdaq here, and it's not dropping as much as the S&P, and you can see right here over those 2 days. But look how tight this was versus the other chart I showed. Now, if we look at today, and just a snapshot of today, we can see that the S&P is actually outperforming the Nasdaq. So what gives? Why the outperformance? Well, first and foremost, let's talk about this. Okay, straight up is not a pattern. These 45-degree angles, this is usually just short covering. If you want to see real buying, you usually will base, come back, retest, fill in there and go higher. This to me just looks like short covering, and we'll see how this plays out. But I would look at this almost as a flag. You could actually really argue that if you clone this right here, and you always want to clone these lines, and you just kind of drill into this and look at it really clearly, you just drop that in right there. You kind of have a channel right there, right? So you can kind of see how this could be one big bear pendant. We'll find out this week how this is going to play out, and I'm going to get into what I think we have to watch. But we can see the clear outperformance in the S&P today versus the Nasdaq, and we do understand that that's rare. And we saw rotation just very quickly. Top performer was utilities, and you can just see it was just an absolute monster today, followed by your Procter & Gamble's and your Clorox's, your staples, followed by healthcare. So what they're doing is they are moving into defensive names. And then if you look at the worst performing group, you're going to see it was the consumer discretionary, it was financials, it was tech. They were the worst. The strongest were the defensive names. Why is that? Well, first Deutsche Bank, second our banks, and we're going to get into that. But there's something going on in the bond market that we should talk about. Now, this chart in front of you, I'm going to break down in a moment. I want to be real clear. This is not my chart. This is by a gentleman named Warren Pies. It is 314 Research, and he's done an excellent job here. So this is very easy for me to explain it, and then I'm going to take the chart apart and show you how they get this line so that you can understand exactly what we're looking at so you can see this. What this is the 2-year Treasury minus the Fed funds rate in basis points. So what you're looking at is a basis point chart, the 2-year Treasury Fed funds rate. You're seeing the color coding where the hiking took place, where the pausing has taken place, and where the cutting has taken place. Do you see a pattern, right? I mean, one always begets the other, right? It's pretty clear where we're going here, to the pause and then to the cut. The question is how long we're going to be in the green, right? Are we going to be long? Are we going to be wide? It depends. We just don't know yet, right? And then we don't know how long we're going to cut for. But these are the stages. These red dotted lines that he's put in here are recessions. Now, this is really very important. This inversion, 75 basis point inversion of the 2-year versus the Fed funds rate is extremely rare. And what you're seeing is the banking sector, and particularly the people that are trading the treasuries, are basically screaming, saying, we have an issue. And that issue is not being addressed. Now, this is not something that happens on a Monday or a Tuesday. It can happen at any time, and it can take a while to build, but you need to pay attention to this. And looking at this, I can tell you firsthand, I went through long-term capital, and that was massive. And if you look at when these happen, they're not warm, fuzzy times. The S&L crisis, 1999 recession, long-term capital management blowing up. And this is what people don't get about when these hedge funds blow up if they're too big. You hear that quote, too big to fail. You had stocks that traded 2 pennies just very simply because they had to liquidate and then went right back up. But it didn't matter because people got liquidated. The tech bubble, the global financial crisis, the repo crisis in 2018-19, and then of course COVID, and now we are here. So this is not where you want to be. If you take a look right here, this is the US 2-year weekly chart. I'm going out to '08, the great financial crisis. You'll remember this chart. We looked at it about a month ago, and I'm doing a lot of follow-up and making these longer because of your comments. So please comment below if you like the format. I've changed the format around to get into some more of the nitty-gritty on what I'm seeing on more of a macro scale so that you can be more prepared for the moves and the longer format. Also, comment below if there is content from other people that they produce that I should probably reach out to try to work in. For example, that gentleman's chart that I posted there, that chart's excellent. So anything I can do like that helps me accentuate a point that I'm trying to make is greatly appreciated. It's one less thing I have to do. So here we are, and we said peaked about a month ago. Now, obviously, I had no idea that we were going to have the single greatest move that we've ever had in the 2-year. But what is this move doing? Well, this gets us to 377 from 5%, which is one of the fastest moves in recorded history, just so we're all clear. That in and of itself sends shockwaves to the market. So if you are short and you're a fund, if you are net short the 2-year and you're a fund, you have a massive problem. So there are funds out there that we haven't even seen that are going to have to reverse those positions that are going to have major issues. Now, here we are in the 2-year, and what does this have to do with that chart? Well, below is the 2-year. I'm sorry, up top is the 2-year. Below is Fed funds rate. So you can see right in here how we're hanging in there, right? And we can see that level pretty clearly. Okay, so we take the 457 and then we look at the 368. We take 368, we minus 457 from it. And that is how we arrive and how this gentleman at 314 Research arrives at that level. This is significant. And this only usually ends one way. It ends with some kind of intervention or ends with some kind of cut. So I just want to be really clear about this chart because there's one data point that when I'm looking at it, what I notice is there's really only one time where we're getting through this, where we're not cutting like 18 months later. You're always getting some kind of bank intervention. And that's the point that I would really want you to take away. If you take one thing away from this, these problems don't fix themselves. They were created by someone, and now we have to fix them. That's what's going on. Now, before we get into Deutsche Bank and what the issues are, in front of you is credit default swaps. And the question that most people are going to ask is, what the heck is a credit default swap? Credit default swap is an insurance policy on a bond. In other words, if you own the bond, you want insurance. The issue with this is not only the movement, which is substantial. Right now, this is accounting for, and they basically walk through 3, the subordinated, the senior preferred, and the senior non-preferred. So it's showing you in colors the rate in which these are going up. To put this into perspective, this is about a 33% chance of default. If you look at history over the past 10 years, you had an intervention back here that got that to come back down, and you had the pandemic here that got this to come down. They're going to have to do some kind of intervention. And the issue that you're running into is that when they did what they did with Credit Suisse and they got rid of those bonds and they kept the equity, they scared the heck out of people, and they scared the bond buyers, the very large hedge funds that buy bonds. They scared them. So what did they do from when that took place? From this point on, they went out there and bought insurance, and they bought insurance on UBS, and they bought insurance on Deutsche Bank because they are concerned. And this, right, let's just say it stays here, which it will not. It will make a decision. It's either going to come down or it's going to go up. If this stays here, their ability to borrow money will essentially cease at the level that they were once borrowing money at. They will have to borrow money at a much higher rate because the people that are buying the bonds are going to have to go out and get insurance against the bonds. I hope that makes sense. But this is significantly important. And both of these events were fixes and interventions. Just like every single one of these was an intervention. It might not have been a rate cut, but there was an intervention in the S&L crisis, this recession. You can obviously see the way that they cut rates. Here, there was an intervention with long-term capital. There were interventions every single step of the way, and we're back here. So the question is, what are they going to do, and how long is it going to take them to do it? Now, before we continue, just to answer that question, I don't have a clue. I just know it's an issue. And if that's an issue, that, again, and I try to make light of it, it doesn't get resolved on a Tuesday. It's going to take time. But if you look at Deutsche Bank and you're looking at this, and I want to throw this caveat out there, I am short this stock. If you are looking at this and you expect miraculously this to go up without some kind of intervention, you're sorely mistaken. It's going to need something. Could it trade up because shorts cover? Absolutely. Could my short go against me and I lose money? Of course. Happens all the time, right? You're always going to lose money in trades. That's not the point. The point is that if you have a system in place, it really doesn't matter because of process. And I'll get into that. And again, you're going to want to watch this video at the end. But I walk through a real simple way to just do your day trades. It's been pretty effective. Got really good comments on it. I might actually put another video out like this on longer term trades. Comment if that's of interest or if you'd rather see a video on options. I'm trying to figure out which one to do first. See how you're wedged in here? Maybe I get up here. But until there's some kind of intervention here, this is not going to happen. Now, Deutsche Bank has massive positions in U.S. commercial real estate. Now, since the beginning of the year, Vornado Realty Trust and any of these names that are in the commercial real estate space have just been getting crushed. But you'll notice this major drop when you cracked the level was late February. Why did we crack this level? Well, this is when they started to realize that the banks might be having an issue. Now, it's impossible for these companies to function the way that they're supposed to function without borrowing money at banks. They put on loans. They are huge loans, and they usually are 3 to 5 years. The issue with this is if companies like VNO, Vornado, cannot go out there and get the financing that they want. Let's say they own a commercial building, a tower in New York City, and they can't get the financing they want because the occupancy is low. They just walk away from the building and the bank's stuck with the building. Okay. And this is one of the issues that you're having at Deutsche Bank. Goldman came out with a statement saying that they think that the losses, if this got worse, could be around $5 to $7 billion. And this is something where it's just a net loss. It's right off the top. So it becomes a real issue. What are you going to do? You're going to hold on to these buildings and they're just going to be losses? No, you're going to turn them around, get somebody in there and try and sell that asset. That's what they do. They don't hold them. Now, this is going to be a real issue, not only for Deutsche Bank, but other companies like this. So if commercial real estate comes in, which it's going to, because we're going to have tighter lending standard. Here's a comment today from Goldman Sachs. Despite a record $360 billion in year-to-date authorizations, the Goldman Sachs buyback desk flow suggests actual year-to-date executions are running well below 2022 levels. Economic data that has historically been leading indicators of CapEx have also turned lower in recent months. That means companies such as Deutsche Bank that were out there buying stock in the open market are no longer buying stock in the open market. That means that they do not have the ability, capital expenditure, to lay out to increase the amount of loan. This is JP Morgan, and what they're explaining here is they're explaining return on assets is impacted by credit costs. We just walked through Deutsche Bank, how they're going to have more money and if the credit default swaps stay where they are, right? So this all ties together. Credit standards have been tightening over the past year. As banks increasingly anticipate a recession, they will likely continue to tighten further. This is a standard channel through which banks play a supporting role in helping the Fed slow economic activity. As things get tighter, as they slow, they're not able to lend. If they're not able to lend, then the companies that have these assets that are on their books, they're going to have an issue. And they're going to have to figure out what they're going to do with the real estate component. There are two more that we should go through here, but I really want to hammer this one point home before we move into the next topic. I don't see any scenario where this just gets rosy for Deutsche Bank without some kind of intervention. And we're not seeing any kinds of interventions into these banks that have been helpful. SIVB, SBNY essentially just went away. Okay, and now there's others that are on the chopping block. Now, FRC is a company I have been on both sides of. I was long this, and now I currently have a short on, and I'll explain why I have a short on. First off, there's nothing redeeming technically about this chart. Nothing. If somebody was going to buy them for a premium, it would have already happened. It's quite obvious that they can't even do a secondary or a capital raise. What appears to be going on here is it appears that what they're trying to do is wait the situation out. Perhaps it gets worse If it gets worse, guess what? They'll put a backstop. If they put a backstop on it, a government backstop like you just saw at Credit Suisse, well, then you might have JP Morgan come in and do a take under. I am currently short this. Nobody wants to lend them money. They can't do a capital raise. They're talking to Lazard about a restructuring. So they're clearly having issues and it's not been resolved. Now, the problem for me is if you've been out a week to 2 weeks on this at this point, you watch Credit Suisse go for pennies and you still can't get it together and figure out what you're supposed to do, or you still can't find a partner. This is a problem and it's not going away. Until this resolves, this is going to be an overhang on the banking system. PACW is another one that I have been playing with, and I've been playing with the preferred, and I've done quite well with it. But here's the issue. The issue is that they are running into somewhat similar problems as FRC. And I'm not entirely sure what the real issue is on the losses, because the losses now should be marked differently because the 10-year came in. In other words, the problem that SIVB ran into was that the 10-year was up here, right? So let's just picture this every time that you move a percentage. So if you're from here, right, and you move 1%, okay, then what you have to think about from that percentage. So again, you started right around here. What was that? That 338. And let's say you take that to right all the way up here. We get that to right up there. All right. And so every percentage that you move in the bond market, you times that by the years outstanding. That's how much the bond moved roughly. Okay. So for every 1%, think about 10% in the bonds. How did this bond do over the past 2 years? Okay. So that kind of tells you the problem that they're in. If anything they bought in 2022, that was a 10-year bond. If you look at it from that perspective, anything that they bought that was a 10-year bond at one point, they were down 3 points. So they were down 30% mark to market. Maybe they were levered like every single bank is, right? So you can start seeing how this can compound upon itself. But what I'm trying to figure out, and I'm having a really tough time wrapping my head around, and I'd love to hear comments, because the only thing that it could be is that the withdrawals are coming out faster. And I'm going to show a couple charts here in a moment. If you look at the 10-year and you look at what's going on here, as you rally, their bond portfolios are getting rid of those losses because they're unrealized losses. So as you dropped from 405, let's say, to 333, let's just say that that's 1%, right? And that would 10 years, so that'd be 10%. Cut that by 75%. So you'd have a 7.5% gain on that if you're unlevered. So that's not a bad spot to be all of a sudden, right? Over a week. And you look at that from March 6th. But then you go back and you take a look at these names. And these names are actually rallying, right, off the bottoms, but they're collapsing as their bond portfolios are doing better. So the bond portfolios are doing better, stocks collapsing, then we're rebounding, right? It defies logic. It makes us think that we're seeing something else. So I'll tell you what I think that we're seeing. The very first that we're seeing is we're seeing the amount of money parked in mutual funds climbs to a fresh record in the week. Now you're looking at 117 billion poured into US money market funds. So we're seeing that happen, and it's pretty substantive. It's the highest level it's ever been. They're at 5.13 trillion. It's not slowing down. Okay? It's actually picking up. If you look at this chart, this is the highest on record that it's ever been. This is from Bloomberg. Now, if we take a look at this, this is US deposits and money market assets. Here you are in trillions. Okay, so we just showed you the one graph from JP Morgan, but now compare this to US bank deposits and money market fund assets. And look at that little cross right there. Now, does that cross look like it might just fit perfectly around that 6 to 9? So even though the portfolio, right, is making money, even though the portfolio is making money, what's happening? Portfolio's going up, deposits are dropping. So what is happening? They're losing enough in deposits that the gains in their bond portfolio are not helping them. That's what I think's going on, and that's what I think the problem is. You have to realize all these banks are out of position, and the money market accounts are much better than what they're getting in their checking or their savings account. So people are moving money. People really aren't a fan of their banks anyway. They charge fees. People hate their banks. There's no real loyalty there. It's very easy to move money. Remember SIVB, they moved something like 20 billion in 24 hours. It was insane. But I want to just point this out, because this is something else that's happened during the same period in time. 2023. You can see the amount of rate hikes that are factored in by the curve here, right? So you have number of hikes and cuts. Maximize, 0 would be hikes. If you're under 0, that would be cuts. We'll get to that in a moment. But you can see the implied rate and the implied policy rate as we get up here. And the Fed wanted something like 5% or 5.1. B of A just lowered that. So I'm sure they're all going to lower it. So now you're coming here and saying, okay, well, 3, well, that's 3.8. All right, if your rate's here and you had to lend money out, you would be able to charge one thing. If you start looking at 324, where you're at currently, right, and you start overlaying how they see this playing out now over this period in time compared to up here, right, you now have rate cuts. So they are predicting massive rate cuts before you're even in December. You're looking at 3 rate cuts, they're saying. So whether this is right or whether this is right doesn't matter. Let's just say that you're in the mean. Let's just say that this went too far and this one went too far. Either way, rates are going to come down. So what's going to happen to banks? Banks are not going to be able to loan money at the same rate that they could when rates were higher. So if your rate, let's just say for the sake of argument, is here, right? And that's really what you can lend at right now. And all of a sudden, now you can lend only here. But at the same time, you have a bond portfolio, right? And that bond portfolio is, let's just say it's only in 10 years. And let's just say that this is what you're getting on your bond portfolio. So you're making that difference. Well, that's the difference that you're making right now. Okay? That's your difference right now. And what's going to be your difference here? Well, your difference now is you're going to take a loss. So you're not going to be able to lend money. You're going to have a real problem there. I don't know how they're going to address it, and I don't know how they're going to reverse people going to money market accounts. So these are the issues that I see that are plaguing us right now, and I just don't see any solutions yet. This is really important. This is from a piece in JP Morgan. And encouragingly giving public disclosures from First Republic Bank and PacWest over the past week, these institutions appear to account for the majority of aggregate borrowing at these facilities. Moreover, in addition to the data released, this is where they borrow the money from, it slowed materially to $32 billion across $225 billion the prior week. So in other words, they borrowed a lot of money and now it's slowed down. It appears that deposit outflows at the very least have slowed, consistent with remarks made by Powell. This is really important because what they're telling you is they're telling you exactly where the money is coming from and where the money is going. It's going to these 2 banks. Now, while all this is going on, this is a chart that we've been looking at for some time, over a month now. And this is the last hour of trading, and it's calculated pretty aggregately. We've walked through this numerous times. Let me just move this down so you can see the dates. But basically what it is you get +1 for if you're rallying in the last hour. Still rallying, we're still seeing buying. So if we zoom in on this, you're still seeing buying. That last hour, we saw it again today. Today felt more like short covering, and we'll see what Monday brings. But nonetheless, you're still here. You're still moving forward. And that is bullish. Now, if we look at the bond spreads and what's going on in the bond spreads, what are the bonds doing? Bonds are hanging in there. We're not even anywhere near these levels. So we're not seeing a panic in any other market except the treasury market, which is kind of fascinating. You're not seeing these spreads widen between investment grade. Now, if you even drill into this, let's go back 6 months. You're actually seeing a peak and you're starting to see them get tighter, which is kind of interesting. Why would they be getting tighter now? So this is something that I'd like to watch as well, and we'll be keeping our eye on that. As this gets tighter, and you'll note back here in October when you moved, you want this spread to be tighter. You don't want it going up. You can actually see the peak in the market from when this spread changed its tune, right? It's actually an inverse relationship between the S&P. The tighter the spread on the investment grades, the better the market does. When it goes up, the worse the market does. Now, these are notes from the newsletter. If you don't get the newsletter, link in description. See how you're lifting here? Look at that negative divergence, right? Let me show you where the negative divergence is. Here's the RSI. So I have the RSI rolling right here. You can see right here in how we're acting. Here's my negative divergence, meaning that this is going up, but the RSI is going down. That is not bullish. and that needs to be paid attention to. That does not mean it can't revert itself, but it's definitely something you want to pay attention to. You can see the higher high here and how this is going on. I did a whole video on RSI. I use it a lot, especially to determine the magnitude of the move and where we're at. And I would be paying attention to this. See this really clearly on the weekly. And you see how we got to the neckline and we were not able to hold that neckline. Now, NVDA is one of the names I always get asked about and when we do the pre-market lives, and it's one that I like playing with. And it's a name that we've been trading for some time. I actually tried to get cute today and shorted at one point because it looked to me like it was going to break this huge flag and it just didn't work. So the strength in it has just been absolutely insane. It's been something we've been playing in on the long side for a long time, but I thought for sure that we'd see more weakness. We didn't. So I don't know if it's a day thing, but I don't know how tech's going to stay up. I actually do have an idea of how tech could possibly stay up, why this happens. And I'll probably do a video on that on Monday, actually, that one piece, because it's pretty fascinating. But it's the mega cap names. There was Goldman had a piece about it and how out of position mutual funds are, historically speaking, with mega cap. And that's really what we've been trading. It is working. But I think that we're getting a little toppy here. Now, we've had a huge move on this. We've done exceptionally well with it. But when the RSI on the weekly starts popping out, you start looking and saying, well, how'd that go? Well, not very well, right? But you have to understand that the magnitude can continue for some time. So I'd probably want to see that lower low before I throw in the towel. But I'd watch this level up here. If you look at today's action, that was a clear rejection. And you can see that you have a doji right there, and get rid of that VWAP right there. And you can see that, right? So you get up there, you're unable to break, and then you roll, and then this starts rolling right back down. You don't want to be here when this happens, okay? You don't want to be on the other side of this when these crack. Now, I say that, and look at what happened here. It just kept on going and not caring what I thought, right? So there's nothing that's 100%, guys. But looking at these higher highs, at some point, this is going to have to give some back. It's just not doing it right now. But you are seeing some strength in those names. Now, if you take a look at Meta and this level, I have this little line right here. I'm just going to drop this in for a second so you can see how steep this thing is. It's absolutely just crazy how steep that's gotten. And the thing that had me laughing about it was just like, I always have this saying, it's straight up's not a pattern. It doesn't matter. It just kept going straight up. Purpose that I'm getting at here is I don't know how this plays out with the market, but if I had to tell you one name that looks really interesting, I'm going to get rid of these earnings at the bottom. If there was one name that was very interesting to me, it's Meta, because I watched part of that. I did very little today, trading wise, but I watched part of that TikTok and the CEO, and they grilled that CEO. And I do think that the probability of a ban is greater than people are thinking that it's going to be. So if there's a ban, I would expect Meta, Snap, but specifically Meta, to benefit greatly from that. It's very hard to look at this chart and not think that this has the ability to go substantially higher if you can get into this gap and push, especially if you do see something like a TikTok ban. And I would suggest anybody that thinks that it can't happen to watch that hearing. They both sides really laid into them. Smart money, dumb money, and as we say, we don't call it that. What we call it is institutions, and we call it retail. And I think this is worth noting. So if you take a look at how this is playing out, we can see how retail got out at the high and how retail's down here. And retail really crushed institutions in October. And it was their turn to pay it back, right? So we thought. Now, we look at the cross here, and from that crossover, as you're selling, institutions are buying. The question is up here, how much more room do they have to buy if retail doesn't start getting involved? And I'm not sure. And I'm watching this really closely because this is a pretty big spread. And usually these spreads can be bullish, but we need to watch this. Now, I do find it interesting that you're starting to see institutions actually revert and start buying more. I don't know how that's going to play out, but I don't see retail really participating yet. Make sure you keep an eye on what is going on in the consumer staples. It's definitely something that I want to watch. One of the easiest things to pay attention to, XLY, XLP, since this is about a third of the economy, you might want to pay attention to this. So XLY, you want to outperform. If XLY is not outperforming, the chances of the market doing well are probably not that great. And we've gone through that. Now, I'm always asked about Tesla, so we should cover it and take a look at it. You're rallying, you're doing okay, but I don't think that's the one to really pay attention to here right now, guys. I do see this setup and you can move, but what is really going to move this, right? What's going to move Tesla? This higher high, flipping the DTL, getting out of this flag. Sure, that could absolutely do it. But there's a larger issue here, right? You have this entire overhang that we're talking about. Now, I hope that we have a great weekend and there is some real discussion here. And so this is going to trade like the market. So you're going to want to watch that level right there on the weekly chart. I find Netflix more interesting. 1 million people signed up with their new ad revenue, which is substantially greater than they thought. And you can see how the stock reacted extremely favorably right there. Never got back down to that 277 and retested. Had a little flip right there, a little piercing pattern, higher high. 350 looks like you're going to see a test in there. So if this market can hold here, I would be looking at Netflix. I like Meta. I think that there's stories there that could differentiate between what we're seeing going in the market right now. If you are struggling at all with day trading, make sure that you watch this video at the end. I've gotten really good reviews on it. If you can comment on this video, the length of it and the detail, because this was obviously a very detailed video, that helps me greatly in creating content and lets me know which way to go with this. Everybody, thanks for watching. If you found value, please share it. Have a great day, everyone.